Did you see the markets today? After being beaten down for a while, Nifty has finally bounced back and is now above the 25,000 level. Now, this rally is closely linked to a very important event, the RBI's MPC meeting that took place today. But before we dive into the details of that meeting, let's first understand why the RBI, our central bank, is so important. Now, one of its jobs is balancing two things, inflation and growth. Think of inflation like the rising prices. While moderate inflation is good and can signify economic growth, high inflation can harm both our purchasing power and the economy. And inflation can be caused by cost push, which is supply chain disruptions, or demand driven. On the other hand, we need the economy to grow so that people can get jobs, businesses can thrive, and overall wealth increases. Now, how does the RBI handle this balancing act? Now, I won't give you full-blown economics lessons, but I'll try to explain this simply. The RBI has the power to increase or decrease the amount of money floating around. If inflation is getting out of hand, the RBI will make borrowing money more expensive by raising interest rates, which is called Repo Rate. This reduces the money people and businesses spend, cooling things down. On the flip side, if growth is slow, the RBI lowers interest rates, making loans cheaper, encouraging people and companies to spend and invest more, which boosts the economy. Now, let's look at how the RBI has tried to balance inflation and economic growth over the last 5 years. Now, we all remember how the COVID-19 pandemic hit our economy hard. Businesses were struggling, people were losing jobs, it was a mess. Now, to help the situation, the RBI made borrowing easier by lowering something called the Repo Rate. In simple terms, this means they made loans cheaper so businesses and people could borrow money more easily, hoping this would kickstart the economy. But just as we were starting to recover, the Russia-Ukraine war created more problems. You see, Russia is one of the world's major oil producers, and because of the war and the sanctions that followed, oil prices shot up to more than $120 per barrel. Now, since India imports around 80% of its oil requirements, we really felt this. Oil got expensive, and as a result, inflation in the country jumped to 7.8%. Now, to give you some context, the RBI's ideal target for inflation is around 4%, so 7.8% was way too high. So what did RBI do to control inflation? It started raising interest rates, which is basically making loans more expensive. The idea is if it costs more to borrow money, people will spend less, and that will help cool down inflation. Now, in line with the strategy, the RBI has implemented 6 consecutive rate hikes totaling 250 basis points. Now, the RBI's MPC, which is a group of people responsible for making these decisions, meet every 2 months to review how the economy is doing and whether inflation is under control. Based on that, they decide whether to raise or lower interest rates. Now, since inflation has been coming down for the past 10 meetings, including the one concluded just in the morning, the RBI has kept the repo rate unchanged at 6.5%. Now, they're trying to keep a balance between not letting inflation get out of hand and still allowing the economy to grow. But here's something important that happened this morning. For the first time in 2 years, the RBI shifted its stance from withdrawal of accommodation to neutral. Now, what does this mean? Now, during the pandemic, the central bank maintained an accommodative stance, meaning it was focused on supporting economic growth by keeping interest rates low and even signaling that it would lower them further if needed. Later, when inflation surged, the RBI shifted to withdrawal of accommodation stance, which meant it started raising rates to control rising prices. Now, after a long time, the RBI has moved to a neutral stance. This means it's no longer biased towards either cutting or raising interest rates. Now, this shift also leaves the door open for the possibility of cutting interest rates in the future if needed, which would make loans cheaper and help the economy grow. However, this potential rate cut is not guaranteed. It all depends on whether inflation stays under control. If prices start rising too fast again, the RBI won't lower interest rates. But if inflation doesn't become a problem, the RBI could go ahead and lower rates to support growth. However, ongoing risks such as geopolitical tensions, market volatility, unpredictable weather, and rising food prices all pose certain inflation risks for us. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.